We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Hey, everybody. Welcome to the Greenlight Retirement Show. We're back again to chat about your favorite financial topics, retirement planning, and what's going on out there in the world. Here with Tim and Corinne Fitzwilliams. How y'all doing?
Doing great. Doing good.
Awesome. And now that we're into fall, we're incredibly jealous of Ron's weather down there in sunny southern Florida. How you doing down there in a polo T-shirt?
Yeah, boy, suffering at 82 degrees, you know, it's rough.
Rough. My goodness. Well,
hey, I was up in Virginia just recently, so I put in my time there as well.
And just real quick, I think we should just remind the audience of who Ron is. Ron is our portfolio manager. He's a chartered financial analyst. Yep. So in some circles and spaces, they would consider him one of the smartest folks in the investment platform that you can possibly hire or have.
That's right. So
thanks, Ron, for being here today.
We're in some good company today for a fun start. We started chatting before we got going. Really encapsulating the value of a financial advisor. There's been a lot of conversations we've had from the do-it-yourselfers in particular, or my neighbor, my friend, somebody's helped me out with some advice, subscribe to a newsletter, something like that. But I have this low-cost, zero-cost fee. Why would I pay, for a financial advisor? Beautiful question.
Well, isn't the whole point is to try to get the best bang for your buck, right? So you want to get the cheapest price you could possibly get. That's what everybody seems to think.
Yeah, that's right. So
but is it right?
Is it right? So we did a little bit of, I say we, but Ron, you did a little bit of homework before we get to the advisory part, but you did a little homework on fees and funds. If you don't know this, if you're invested in a mutual fund or an ETF, they have an expense ratio. There's a cost to manage said fund.
I'm sure Ron knows that.
Yeah, well, for our listeners here, hey, there's, your advisor costs money.
I've heard of this before.
I've never heard of this before. But, your advisor might cost you some money, and your fund could also cost you some money. So Ron had did a little study on the cost of the actual funds, the underlying investments. You want to give everybody a peek behind the curtain of what that research was?
So this was really the second time I've done this kind of research. The first time was back in the 2007, 2008 era, and then did it again recently. And what we did was we were interested in finding out if expense ratios of mutual funds really make a difference in the outcome. Because it doesn't matter, in our thinking, does it really matter if the expense ratio is higher? What really matters is the performance, the outcome.
Right.
And sometimes you have to pay more to get better performance. So to research this, what we did was we took a group of mutual funds that had the same investment objectives, such as large cap growth funds. And then we looked at their expense ratios, expensive to least expensive. And probably not a big surprise, the Vanguard fund was the cheapest because that's what they're known for. And then we looked at the performance for those funds out, 3-5 years out to see how did that go? Which funds had the best performance? And without going too deeply into the numbers, in both of these studies that we did, we found that the expense ratios are actually very non-informative when it comes to the outcome, the performance and the outcome. So in other words, it's not the most expensive fund that got the worst or the best. And it's not the least expensive fund that got the worst or the best performance. It really comes down to who is managing the fund and how they're managing it. So even though they have the same investment objective, it's the way the fund is managed that makes the difference, not the expense ratio.
I see. So what about A shares where you pay the fee up front? Do you see a similar logic with that as well?
Sure. So, and that's what we used, Tim, for this study was the A shares.
Okay.
And where that really makes a difference is if you're investing in, say we identify the best mutual fund out there for large cap growth. Mm-hmm. they would have several different share classes. Like the A share class is usually the upfront load. The B share has a back end load and a sales fee attached to it. And then there's usually an investor class, which is what investment advisors, and like we do, put our clients into. And that typically has the lowest expense ratio because we're not getting paid a fee, a commission or an upfront load, and we're not getting paid a trailing fee, which the Class B shares pay. So it eliminates all that. So that does make a difference if you can get the investor shares versus the A class shares within the same fund. Does that make sense?
It does.
Yes.
And in all scenarios, though, it sounds like, how it gets managed and who the advisor actually is. Now, unpacking that a little bit further, though, did the cheapest mutual fund ever outperform? Or would it be fair to say that paying above the the floor price, if you will, of admission was more advantageous?
Yeah, in both the studies, the cheapest fund did outperform the market, the broad market, because it was a little bit. These were not index funds, but it never did the best.
Interesting. So there's a value to the advisor right there for everybody in this little segment that we're talking about. I want to pivot to you, Tim. That's on the portfolio side. Let's talk a little bit about the value of an advisor inside of a conference room, looking over a financial plan, understanding your budget, your income, assets, and expenses. Like, how can an advisor add value in that arena?
Yeah, I think first you have to identify what people's goals are, what their expectations are, and then their risk tolerance. And once you've identified these things, you can then get into conversations of what's more important to you: growth, income, what strategy are you really focused on? And what we find 9 times out of 10, it's funny, is that realistically it always comes back to income. However, that's not what it is in people's minds. They think growth. But then when you ask someone, hey, you were working all these years, why did you put away? So that I could retire and I could have some income.
Yep.
I could spend and do things that I want to do in retirement. So we help to dissect that and really analyze, well, what type of income do you need? What type of growth do you want?
Sure.
And then we get deeper with that in the risk tolerance, and we get rational with it in saying, well, you're going to be doing this for the rest of your life. And so if you have X amount of dollars saved up and you're going to take distributions from these dollars, there's a big question that comes to mind that nobody thinks about because no one ever is concerned with all the little dips in the market.
Sure.
Because why? Because it always comes back.
That's right.
Because the beginning of this year, we have a dip, but we're back. And so no one ever stops and says, well, what if I could have done something different during the dip? Would that have affected where I am today? And there's no need to ask that question because you look at your accounts, you're like, oh, I'm up, I'm good. You're happy.
I think right there, that is the point of differentiation, right? What you just described was taking a scenario where you either ride it through with a low cost, low fee type of a thing, or you turn to be a little bit more optimal. And so what you're speaking to is just, the value of your advisor can help, gain optimality. You're speaking to it from the context of income planning. Alongside income planning, you have tax planning. Alongside tax planning, you've got estate planning, insurance planning, legacy planning, and that goes into the goals that you mentioned to design in that plan.
Yeah,
I'm going to jump in real quick.
Corinne, what you got?
The concept of, paying an advisory fee. I don't manage our accounts. Thankfully, we have a wonderful team that does.
Yeah.
But my son, he's 15. He's got a saving. It's a Greenlight account is what it's called, which is funny because you've got the Greenlight retirement book. But the Greenlight account is like for kids and teens. It's a way for them to manage their allowances and their savings and stuff. But what's interesting is that they have a way where they can invest. And what's cool about the investment concept is they get to choose what they want to invest it in. And there's no fees, which he was like, that's so cool. I don't have to pay these fees like he's learning about with the testing that you had been studying for, that he was helping you study with. He's like, with the Greenlight account, I don't have any fees that I have to pay. If I want to invest in something, I put the buy out there and I invest, and then I just get to watch. And the problem is, he goes to school Monday through Friday and he's not paying attention to the account, and nobody but him is responsible for it. And what he thought was going to be a stellar stock takes a huge dip. And then he goes on the weekend when it's, allowance paying in, and he wants to go see what his stocks were doing.
Yep.
And he's like, it's down. I'm losing money. I did all my chores this week and I'm negative. Not negative, but like lower.
Yeah.
And I'm like, that's the risk of you putting into what you think you...
Right, doing it yourself.
Yeah, you didn't have to pay
investing
anybody.
Yeah, he's realizing that the cheapest fee, or no fee in this case, can have consequences. And that goes back to my down conversation of if there's a drop in the market, do you care or should you care? And I believe the answer is yes, because if you could have less of that drop, if you lost less, even though you're back today, if you lost less at that moment in time, you would have more mathematically, you would have more today. And if the name of the game is always to have more, then the question is are you going to have enough that it makes it worth it to have an advisor and pay a fee?
That's right. Well, we're going to give you all a little bit more, but right after this break. We'll be right back. All right, welcome back, everybody, to the Greenlight Retirement Show, and we are deep into, do advisors have any sort of value whatsoever in your portfolio?
Right.
You're listening to us now, so give us another 10 minutes, and let's talk about it a little bit.
Right, we were talking about if the market's down and you lose less, you'll make more.
That's right.
So you can't pay a fee that's going to be so much that doesn't work in your favor. So you have to make sure that when you're paying the fee, you're getting a value. But if you're getting a value, the fee shouldn't matter. So let's talk to our chartered financial analyst, and let's find out a little bit about what happened and the value he created for our clients across the board in the beginning of the year when the NVIDIA had a little hiccup and people were down 15 to 20%.
The tariff tantrum.
The tariff.
A little hiccup, the little tariff hiccup.
Yeah.
Which is just keeping on giving to us, right? It's a gift that keeps on giving.
That's right.
But people are getting used to it, I think. So at the beginning of the year, everybody was all on board with the AI craze, and everyone was very excited because we had a new administration coming into the White House, and unfortunately, not a lot of people had actually been listening to what President Trump had been saying as candidate Trump, and he did exactly what he said he was going to do. He came in and he said, I'm going to start doing tariffs. Everybody assumed that those tariffs were going to be somewhere like what he did in his first administration. But he came in and he walloped us all. He showed, remember the chart that he showed in the Rose Garden, and the tariff amounts were staggering compared to what everyone was expecting. And so the markets had no idea where to go with this and began to sell off immediately. And the one area that took the biggest hit, of course, were the stocks that had the biggest gains running up to this. And so that would be the Magnificent Seven stocks. We're talking the AI stocks and NVIDIA and that whole crowd. And with that downturn, those stocks lost about 28%.
Yeah, wow.
It was an amazing pullback. Now, that's not the great financial crisis that we had back in 2007, 2008. It's not the dot-com bubble bursting, but it's big, and it hurt. As we saw this coming on board, what we do is we create a list of trades that we're going to do should certain situations occur, should we meet certain conditions, right? And so as the conditions were being met and we saw the risk levels rising in the marketplace, we were already reducing our exposure to the market and getting prepared for some kind of sell-off to happen. So when it started happening, we were already well prepared to take advantage of that. And as it continued to happen, we actually were able to do some of our more advanced techniques, such as using inverse strategies where we enter into a hedge that actually rises while the market falls. So that reduces the exposure to the market all the more. And as a result of that, our average client during that time, when the Mag 7 was down 28%, the S&P was down some 12%, we were down more in the range of 5% for our average client.
That's phenomenal.
And then,
Was that net of fees, Ron, or gross of fees?
Because that's what we're talking about, right?
yes, that was net of fees.
So you're
So if
saying
you
that.
think about it,
Yeah, go ahead.
I was just going to say, if you think about it in terms of fees, how many years of fees did we just save our client
Right.
by doing that?
Exactly. Yeah. So what we're saying is, Ron's managing a portfolio, charging a fee, and let's just say he's the most expensive he can be, and he's not. But let's just say he is. For the purpose of this, let's say the legal ceiling is 3% according to the SEC. So let's just use that number. Right. And you got your cousin who just got licensed and is hanging out and is like, I'll do you a solid and I'm going to do this here.
I'm going to show you this Mag 7 ETF. You buy this Mag 7 ETF, I'm going to charge you nothing.
I'm not going to charge you anything. You're my cousin. Who was more expensive at that moment in time?
Mag 7 down 25, 27%.
Right.
You know, strategy charging 3% annualized. You're only in April, by the way, so you probably only paid a percent so far, and you're at 4 or 5%. There's a 20% upside there.
20%. Now, again, none of us think about that because everything comes back and we're good and we're happy. But what if we could just snapshot that moment in time, make it a strategic move at that exact moment in time, like Ron did, and create value? That, Brian, is why you pay a financial advisor, to create value in moments of time where they need to be strategic. And that is the definition of active management.
That's right.
And that is something that, unless you're going to internalize, back to the example of our son, unless he sits there every day and try to understand what he's going to do in case something goes wrong, you're not going to be able to do it. And then your tools are limited at that. Now, I definitely want us to get into that.
Well, let me also add this for Timmy's sake as well, too. Even if he dedicates his time, is he still going to make mistakes?
Absolutely.
Now,
No, he's 15 years old. He doesn't make mistakes.
Yeah, that's right.
How could he make a mistake?
I almost went a different direction with the conversation right there about, you know, letting 15-year-olds make adult decisions.
That's why I don't get involved in the stock portfolio. I'm like, just do what you want, man. Do whatever.
Ron, how long have you been doing portfolio management?
So I
Since
started,
before Timmy was born.
Yeah.
Since before my married kids were born.
Yeah.
So it's been about 30 years. Actually 32
So you've seen a
years.
few ups and downs.
Well, Ron, you've made mistakes before, right, too? You've probably, of all the stuff we were talking about, you've probably lost some money before, right? So these lessons are expensive.
Absolutely have, yes.
These lessons are expensive, so you can pay an advisor a fee, and even your advisor is human, and they can make mistakes as well, too. But it's this learning curve and this experience curve that's going to be your hedge. And that's why you pay management fees, is you pay for the experience in areas where you have less experience. Not being disrespectful, I'm not saying somebody has no experience, but it's hard to have 30 years worth of experience that's going to equate to a chartered financial analyst.
Yeah, we're not saying it's going to guarantee it either. We're just saying you're getting better odds.
Another thing that I want to point out, because many of our listeners, our clientele, are of a certain age where, you know, our son, he's young enough that he can afford to make mistakes in his Greenlight account.
20% loss on $50 is only $10.
He's actually got a lot of money in his account. He's doing all right. But, you know, he's young enough, and he's going to see next week's allowance hit again. Our clients that are, you know, a few months away from retirement or a year away from retirement or just retired last year, those dips, when they hit, they hurt more because you've got to scratch, claw, and dig your way out of them.
Yeah, that's a great point. So you're saying when you're working, you're saying the hurt is less because you're constantly putting money in.
Yeah.
So, Corinne, from your experience, when things like this have happened, because we've been doing this for a little while, do you hear about as many client vacation stories during a down market?
No. A lot more drinking at home in the backyard versus doing the Carnival Cruise drink package. Yeah. It's different when you're close to retirement or retired because it's going to affect so many other choices. You're not going to build that pool this year. You might not go visit your grandkids in Nebraska. You might have to downsize the home that you thought you were going to stay in.
Right.
And those kind of things can be easily, I wouldn't say easily avoided, but but controlled by using a proper guy like Ron. I mean, I'm thankful that I don't have to wake up every morning and be married to one of those guys that is drinking his coffee while managing the stocks in his Excel sheet. Because we have clients that were like that before they came to us, and their wives, they come to our Fridays and they're like, it's like having a whole new husband.
And we really try to, like, it's funny, yesterday actually, I'm literally talking to the guy, saved up about $1.5 million, and he's talking about vacation, and I just assume, because I've met with so many people, I just know the truth, just no one wants to admit it. And it's not that I'm some super genius, I've just seen it and learned from the clients. I'm like, let's be honest, if the market drops 15-20%, you are not taking the same vacation. And he was like, yeah, you're right. And when you really think about it, that goes for all of us. Nobody wants to just go out and have a great time when the market's down.
Well, and I think that's because everybody lives in this just-in-case retirement. I need to keep this money just in case and just in case. And the unfortunate thing is time keeps on going. Days turn to weeks, weeks to months, months to years, right? That
Where
sounds
we heard that? Yeah.
Where have we heard that before, right, Tim? But here, this beautiful life that we have, we only get one of them.
That's right.
And so when days turn to weeks to months to years, all of a sudden we might not be able to backpack around Europe. We might not be able to go to the wineries in Italy. Heck, we might not be able to make it to Charlottesville to go to a winery at some point in time as well, too. So I think in many ways the behavioral side of financial planning and portfolio management is core and central to why you should choose a financial advisor, is to remove the stress, to have a plan. You can look forward at a horizon to know what you have to spend, from income planning to what Tim's talking about, to protecting assets in down markets like Ron is talking about, to give yourself the peace of mind to retire stress-free, relatively stress-free. And not let your finances be a burden to you, so you can experience life the way you were intended to.
Well, let's play devil's advocate. What if I wanted to learn it all myself? So let's say I'm an astute person. I did good in college. I do good in my career. I'm smart. I'm an engineer. I know what I'm doing, right? And so I'm just going to broaden my day a little bit. I'll get up about 2 hours earlier, so that way I'm, in the chair looking at my news with my cup of coffee and identifying what strategic positions I should take. Ron, why wouldn't that work? Or would it work?
Well, the first question that I would want to address with you, Tim, is where are you getting your information from? Because if you're turning on the Today Show or Facebook or TikTok, and that's where you're getting your information, you have no idea the validity of any of those things. What we do as professionals is I don't look at the headlines. I don't look at the news reporting. I go directly to the source of the data and analyze what's coming out.
Well, hold on now.
That is a significant cost associated with that.
Okay, but what if I was just to get like the Wall Street Journal, or subscribe to the Wall Street Journal, or like the street.com, or one of those sites? Would I be able to just do the Wall Street Journal and read that every day?
Well, if you want to follow the crowd, you can do exactly what everybody else is doing after they're already doing it. And that's the trick. When it comes into the Wall Street Journal, it's already known. We often have conversations at home where my wife will say, hey, I heard about this today, or she has a lot of clients who are financial advisors, and they'll, she'll say, oh, I heard about this from them. And I'll say, yeah, I knew about that 3 days ago. We're already repositioned for that, and we're already doing these things, because when you get your data directly from the source instead of getting it from some news desk, it makes a difference.
All right, so let's say I'm like, this is my money, this is my life savings. I guess I'll invest. What source do I need to get it from?
Well, your source you need to get it from is by going to Fitzwilliams Financial,
right,
and hiring.
Yeah, I totally agree. But like, let's say, like, am I going to subscribe to some technical software? Am I going to have to learn this stuff and study it?
Service?
Is there charting? Like, how deep? Like, what I would have to subscribe to these things is what you're saying?
Right. So there's a lot of software out there that makes a big sales pitch and says we use AI.
Right, that's what I'm getting at.
And do all these things. And, I've studied these things over 30 years, because if I could find something that would give me a better edge, I want it. And
right.
I can pay for it. This is my profession. And I have yet to find something that really delivers on those promises by itself. I use a myriad of sources. There's probably 7 or 8 different sources of data, high-level data that I use, including artificial intelligence engines that are specifically designed for the financial world. And that's what I use to dig in and do
Like
research.
7 or 8?
And I have to say,
Oh, that's just metadata. That's not even.
Wow.
That's not filtered data. That's the metadata.
Well, then I'm not getting up like 2 hours early anymore. I'm going to have to stay up all night, it sounds like, in order to get all the service that I need. Because I got to go to work, you know? Where am I going to have the time to do this?
Yeah, keep in mind that the markets are open 24 hours a day.
That's true, too.
There's always a market trading somewhere. So you have to be able to see even a big picture idea of what's going on. So we have to be able to be versed well in not just understanding, hey, NVIDIA is a great stock, but what's going on with the AI industry and how's that affecting the industrial sector? Because Caterpillar is actually a big beneficiary of the artificial intelligence movement. How does that work? And what do chips have to do with artificial intelligence? How does that work? What about software? And then what about trade and the global economy? How does this all fit together? What about the dollar versus the euro? Is that being affected by this? So there's a lot of different things that are in play.
A lot of variables.
Not to toot my own horn, but as a chartered financial analyst, they have what they call the candidate body of knowledge, right? Which is all the stuff we have to learn to take the test. And I printed out the outline, not all the information, just the outline. And the outline was 25 pages long.
Wow.
So just line by line, these are all the topics that you have to know in depth.
So what we're saying is you really can't do this on your own unless you just get lucky. It's really difficult to really try to manage actively on your own.
I mean, there's people out there like Brian that are just walking calculators and love this stuff and would rather read Bloomberg reports than go to a bar with buddies. And so over the years, we've had 1 or 2 clients that successfully pulled it off. But, you know, they're coming in with unhappy wives. They're coming in with grayer hair than they need. They're coming in where they don't get to enjoy a weekend because they're stressed out over things.
So it has a net effect, right? When it's not your career, you're adding basically a part-time job is what it sounds like to learn this stuff. And not even at Ron's level, but just to learn enough.
We just had a guy at our house because we had a few things on my honey-do list. And I asked him about installing a new thermostat for my upstairs unit that I bought. Right. And, you know, I sat there and I'm like, I could do this myself. I can install this in like 15 minutes. Why wouldn't I just do it myself? And it's like, you think about it and you're like, yeah, I could, but he's going to do it better. He's going to do it quicker. And I'm not going to have the risk involved.
Electrocute yourself.
Yeah. Right. So, I mean, just because you can do it doesn't mean you're really, I mean, if you don't value yourself, like, you have to have an understanding of what an hour of your time is worth because you don't get time back.
Right, that's a good point. So what are you best at is really what it comes down to. If you've chosen a career, you chose a career for that reason, hopefully, because that's how you get successful, right? It's to be good at your job.
And if you're later in your career, you've probably specialized at some level as well, too. So you've advanced and you become even more special at what it is that you do, maybe even a niche inside of your
And so if you
career.
step over into our side of the world and you're not treating it like a career, then you're kind of like doing it half-stepped. You're not really you're not going to be able to get all the different services he has or all the different information.
Corinne said it in her own ways right there about the thermostat. It's about how optimal does the thermostat get installed. You know, is there gaps? Are you going to be able to, is it painted? Is it finished? Is it ready to go? You know, when you step outside your area of expertise, you're not going to be able to perform at the same level as a professional inside that category. So it comes down to optimality. If you want to have a market-based savings account and buy an index fund, that's one thing, but you have to know by the numbers, as Rounds ran the numbers and we're sharing with you, you know, go look up Vanguard studies and Russell Investment studies as well too. More optimality equals a greater % net return, which means more cash to you and your family.
Now, you're probably going to have to pay a higher fee too, is right? You're probably going to have to pay a higher fee because you need that person to be an expert.
Mm-hmm. I will also tell you, you know, when the guy was installing the thermostat for me, I did enjoy sitting there watching him and being like, Well, why did you tape that? Well, oh, I like the idea of marking that, so you don't have to question. It was fun to chat with him while he did it, and I know with you
I'm sure
guys,
that was fun for him too.
yeah. And I know with you guys, these engineers that like to come in with their Excel sheets and their books similar to Bibles, even though you guys take over this baby of theirs and it's now your responsibility, you guys still happily take their calls. You talk to them about things. They still get to enjoy the activity without having to take the stress. And it's really a great pressure release, because a lot of the people that manage their own money, if you're a married man and you're doing this and something happens to you, your wife's not going to be able to do it. She's going to be sitting there dealing with the loss of her husband, the loss of the income, the stress of I've got bills to pay, I've got a funeral to plan, and what's going on with my NVIDIA stock? How do I log in? How do I make these changes? It's so much better when, someone else is handling that for them, because...
And that's even if, like, in today's world, the wife could be super successful.
Yeah.
Could be the breadwinner, but maybe not handling the finances, or vice versa. It could go either way. The point is that it's hard to be an expert in something that's not your job. And if someone is doing it for you, it's hard to have two people in the household doing it. We very rarely ever see that. I don't think I can even remember the time that I saw two people that were married saying, no, we both manage our finances separately. Not day-to-day spending, checking.
Separately.
I'm talking about investments separately. We never really hear that.
No.
So, yeah, if someone dies or gets sick or not able to do it, you're really in a bad position, because you may be in your income distribution phase and the market's down. You could
also
have an emergency. A lot of
the
stuff.
get sick is another scary thing, in my opinion, because let's say your husband, like, I'm married to Tim and he can do this, but he doesn't. We've got our team members, but, God forbid he is the person managing it all, and he's got the accounts and he's got the software and he's doing it, at 6 a.m. every day. What if he doesn't die, but he starts getting a little forgetful like your dad did? What if he starts, dealing with other health issues and he's not gone? I'm not suddenly in charge of everything, but what if he's suddenly not all there?
That's true.
That's right.
Because that can be a really scary thing when the person who you think, like when Tim's dad started losing it, he had his bank accounts that he swore, all of his money was in it. And then when he passed, we were like, thank God Tim had taken over things, because he had money moved. He had gone to the bank that's in Walmart and opened up an account just to move money over to it, because he was in Walmart and thought that he needed a bank account. And they let him do it because he was of his right mind.
Right.
Well, let's talk about what stage of life that is, too, for the wife to pick up the ball there, or the spouse to pick up the ball there. You're generally not in your 40s, 50s, or 60s, maybe, where you can easily pick up a brand new concept and run with it. The really, really tough part, and Ron mentioned this earlier, is the body of knowledge that's required for finance. And by the way, like, what Ron talked about was most of what we deal with, but that's still not even all of what we deal with on the financial planning and estate planning and things side of that as well, too. There's other nuanced elements. One of the reasons I actually enjoy this profession is, to me, it's an infinite amount of things that I can learn. I don't think if I studied every single day of my life, I would ever get to the bottom of this knowledge of finance, because of all the interconnectedness and the global, economies and if this then that factors as well too. So I've seen widows and widowers try to pick up finance and learn it in their 60s, and I'm a patient person. I'm happy to chat with you, but it's challenging. It's unnerving, and
technology is against you.
And technology is against you. If technology isn't your friend here, that's going to be challenging.
You can't keep up without effective technology skills in today's market. You heard what Ron was saying. He has AI in his back pocket. You have to have skills when it comes to moving around multiple different apps, interaction with different applications, saving profiles and applications, building strategies and what-if scenarios. It's very
I know we're coming
now.
Close to our time on this segment, so I want to also point out, besides just beating it over everyone's head, how the fee can most often be better than doing it on your own. I also want to point out that there are other things that come along with this that we haven't even touched on, like with our clients that have their money in, Timmy in his Greenlight account. End of the year, he gets a little piece of paper and that's it. We're expected to know what to do with it as far as the taxes goes. Whereas at our company, we have so many different moving parts that we know what's going on with your bank accounts. We know what your income sources are. We're aware of you and your wife or spouse's investments, and we ensure that when Uncle Sam comes knocking, that you're protected, that all the puzzle pieces are fitting together, and you don't get that a lot of other places. And there's other things besides that too that we could get into if we had more than.
Our goal, is to always have a synergistic effect. Synergy, right? We want to have your tax planning, your insurance planning, your investment planning, all of that, estate planning, all under one roof. And that's what we've achieved here with our firm. That was our vision, to bring Wall Street to Main Street and find the best in their lanes. Whereas a lot of other firms will pawn you off or give you a referral. It's totally different when it's all in-house because everyone's on the same page working on your plan, all with one number to call. That was our vision. That was our goal. And that's what we strive to do, is to let the experts do what they do. As I learned in economics, do what you do best and trade for the rest.
Hey, welcome back, everybody, to the Greenlight Retirement Show. We've been talking about fees about the entire time, and if you're still with us thus far, you probably have been convinced at some level that paying a fee is okay at some level. So we wanted to kind of capstone today's conversation with getting value for your fee, because not all advisors are created equal, not all strategies are created equal, not all types of advisory services are even created equal as well, too. And so let's crack open this nut and help you, the consumer, the client, if you will, extract the most value for the fee that you are considering paying.
Well, I definitely have something to say about that, because when I started the investment side of the firm, I thought about that a lot. How do I get a good trader? How do I get someone good at stocks? Where do I go to look? What comes to mind? And so immediately you turn to, well, what, in my mind, in economics, you always look at like the extremities. So I said, okay, let's look at Vanguard. They're one of the largest funds out there. We can kind of understand that they know what they're doing at some level. But more importantly, let's find out behind the scenes who's calling the shots.
Yeah.
So you look at the prospectus and you find out in these mutual funds that majority of the time, and everyone that I've seen, in fact, I haven't seen one that wasn't, but you look at the fund manager and you're going to see that they are a chartered financial analyst. So that told me, oh, there we go. That's the mad scientist you need to have to manage the portfolio. Here's the downside. When I started shopping around and trying to figure that out, you need to like $20 million to even have a conversation. In fact, one time, I remember I was on a plane and I was coming back from a vacation. I was sitting next to the wife of one, and it wasn't like I was, not able to explain who I was or anything like that. We were both sitting in first class. So there was a mutual respect there that were probably business people. And I found out through just casual conversation that she was the wife of the CFA managing our portfolio at this particular company at the time. And I was like, yeah, I've been wanting to talk to them. Can you get them to give me a call? I'm the owner. These are the dollars we just gave them. Love to talk to them. Want to go over a little bit about how our clients are feeling.
Yeah, develop a relationship.
Yeah, develop a relationship. And I never got the phone call. Even me as the firm owner who gave them the money. At that time, it was around $15 million. We still didn't get the phone call. We still didn't get to talk to them about how we feel about things so we could better understand how to position them.
Well, so we worked with a company before we met Ron, and Ron was brought to us by God, for those of you that don't know. We're so thankful to have Ron in our lives. But we worked with a company that managed our funds, and I don't remember, or I don't want to say the name, but, they prided themselves on, we have 16 of CFAs and CPAs and all these other people.
About, right.
But then, you've got a client and you want to set up an appointment and you're like, our client has some questions. And they're like, okay, well, our frequently asked questions sheet can be found on our website and you can look here. And they're like, no, we don't communicate with them. We keep them like in the basement. Their job is to look at numbers. They don't talk to people.
Yep.
Right. We
And
couldn't
these
talk to
folks-
them. And the number one question we wanted to know from our clients at this moment in time, oil was down or something, right? And we wanted to know if something continues to happen, what are you guys going to do today? Why do we need to wait 2 months from now to revisit the portfolio and make a change?
And
So I
you
just
guys
want to
are-
repeat that one more time.
Yeah.
We asked, what are you going to do today if something was to happen? And their answer was nothing. And that got us into a hunt to try to find an advisor that gave us more value, right? Because you said that there's a difference between advisors with fees. We were paying a fee, and it was
It's
a decent fee, but we decided to actually look at, even a stronger model, right? We were okay with maybe paying more of a fee if we could get a value.
So you guys
and
are
that
on-
brought us into
Yeah.
our conversation with Ron on what would you do today.
Yeah, and so to that, right there, an answer to a simple question, hey, I'm paying an advisor a fee, ask that advisor, if something happens in my portfolio today, if something out there in the world happens today, will something in my portfolio happen today? There's two different advisors. One's going to say, yes, I'm going to do something, and the other's going to say no. So there's a difference in active and passive management. There's a difference in calendar-based rebalancing as opposed to event-driven rebalancing.
Right.
You've got second levels. to
Brian,
this.
if I
Please go ahead.
This is your
if I
world.
could just
Go
jump
ahead.
in there too.
Yeah.
Yeah, just jump in there too. I would say it's not just, I would do something. What I tell you is right now I already have a list of the next 5 steps that I'm going to take.
Yeah.
Right.
Should things begin to happen
You have an action plan.
on both sides.
Actually, we got to back up
So,
a segment
you-
because your point right there, for every buying plan that you might have, you also need to have a selling plan, right?
Yeah,
that's also
that's
good.
a deep point.
Absolutely.
So most people enter into
Absolutely.
things and don't know what the
I hope
exit
this is going to
looks
do
like.
well, but they never plan, well, how do I get out of it and it doesn't? And that, I think, is
Absolutely.
important. That's a good point. Very good point. Yeah, so yeah, Ron, the speed to the trigger is important. And in your world with the CFAs, then they're normally for private wealth or very large companies. That's who gets the speed to the trigger normally, right?
Absolutely. And because they have the technology, they have the personnel, they have the ability to do the things. And we also have the technology and the personnel and the ability to do these things. And
Right.
that's the value that we bring.
Another thing that I like about working with Ron is that, Tim and I are a little bit younger than most of our general clientele. And, working with Ron, we have the benefit of choosing how much risk we want to put in to different things. Whereas, not all places can you.
Oh, that's a great point. A lot of
Value.
CFAs get super cocky, and they're like, this is my model.
Oh, yeah.
You're going to follow the contrarian model, or we're going to follow this model, or we're only going to do this. It's
Yep.
my theory, my algorithm. You're either in or you're out.
Right.
And that's not who we are.
Well-
We do it based off risk tolerance. If you want to go pedal to the metal, then you go pedal to the metal. If you want to dial it back and, go the speed limit,
That's
then we can do
important.
that as well.
That's important as well too, because you're getting value for the fee that you feel like paying based on the risk that you're willing to
Right.
accept. Everybody loves being outside their risk tolerance on the way up because you're making
Until
money.
it comes down.
I love to say
Right,
you're
right.
making money on accident right now.
Right.
Because you're outside your risk
Right.
tolerance, you'd be very upset if it was the equal percentage on the way down. If you're happy and excited with 20% up, imagine 20% down.
Yeah.
Right, because you have to be willing to take that in general for that risk tolerance to really.
You're right. You're
take an
supposed to
impact.
be able to agree to that. And what's funny is when you actually look in the mirror and you ask people, man, I made 20% this year. Well, what if I lost 20%? Would you stay the course? Would you stay in the same solution?
How do you feel? Do you
How
go
do
on
you
vacation?
feel?
Yeah, yeah.
Exactly.
Also, there's something to the fact that when you've made 20% and your account with 100K turns into 120, when you lose 20%, you're losing 20% of 120.
That's a good point.
So that 20, that those
Absolutely.
drops hurt worse in
That's
a lot
why
of
it takes
cases
more to
too.
get back. It takes double to get back from the drop. Double to get back from the drop. Because of your point earlier, if you're retired and you're not putting into your account, then it's going to take double to get back. So what have we learned here? We learned that fees do matter. Fees can erode your returns. But if you can get a value for your fee, then you can actually come out on top. And if you can have the advisor prove to you or show you to the best of their ability what their value is, that they lose less in volatile markets, which is what we try to do here at Fitzwilliams Financial and what Ron's so good at. Our opinion is to try to lose less in volatile markets so you can make more in good markets. Have the advisors show you the value so that you can be confident that your portfolio can be managed for you according to your risk tolerance and you don't have to worry about these risks. So if that's you and you don't want to have to worry about the concern and the stress and the risk, give us a call. Come out to one of our events or call us at 757-961-0700 or find us on the web at fitzwilliamsfinancial.com.
We've had a lot of fun chatting with y'all today. We have more to talk about. Come see us next time on the Greenlight Retirement Show. See ya.